Let's talk about the different characteristics of debt. Not all debt is made equal. You have senior debt, you have junior debt, you have short-term debt versus long-term debt. You have debt that uses instruments above investment grade, below investment grade, and many other variants. So it's important to be aware of these differences because these have consequences for the lender and borrower. Let's take a look. Let's talk about the different characteristics of debt. Before we dive into specific strategies or structures, it's important to know what types of debt can exist. There are a set of parameters which are usually binary, so it's either one extreme or the other. So usually, debt can be either public or private. The type of instruments, either they're available to a whole market or some private individuals. Debt can either finance company operations or a transaction. So you request money to finance the operations of your company or to finance a deal such as buying a company. Then it can be short or long term. Usually short term is 1 year or less and more frequent for consumers and small businesses, and long term is anything above that. Then it can be investment grade or not. So the underlying instruments either have a good credit rating above BBB minus or they don't. Then debt can be secured or not. Either something is used as collateral in case of default or not. It can have a fixed or a floating interest rate. That is, it's either a fixed value or a floating rate pegged to an interbank offered rate, such as the LIBOR or Euribor. Then it can be a term loan or a revolving credit line. So it's either one specific amount for one period of time or multiple repeated loans for that period of time. Then it can be committed or uncommitted. So the lender may have to lend the funds without choice, they're committed, or they can have a choice to pull out if they want, uncommitted. And finally, it can usually be provided either by banks, by private lenders, or by the bond market. So in more detail, debt can usually leverage public or private instruments. Public instruments, or in other words, securities that are either available to any investor in the market or made available only to specific ones. Public instruments usually involve commercial paper, public bonds, or capital market instruments, while private debt usually includes bank debt or private placements. It's not public. Or maybe bonds issued privately by the borrower only to specific lenders. In general terms, public debt is less costly, but it's regulated and it has more transparency requirements, and vice versa. For example, the only way that you can find information on the financing for a transaction, for example, if you're an investment banker trying to do a comparables analysis, is if the transaction included public securities, because in that case, it has to be disclosed. But if it only involved private securities, you may not find any information at all on the internet. Then, debt is used to either finance corporate operations or a transaction, which is usually a merger or acquisition. So for example, a company obtaining a $500 million revolving credit line will use it to finance operations, maybe to use as a financial cushion in terms of inventory production or accounts receivable. That's financing operations. On the other hand, if it's a private equity firm, also known as the sponsor of the deal, raising $500 million for a leveraged buyout, it's transaction financing. Usually, you will also see this difference in terminology, both in private debt and private equity. When it's a company that's involved, it's a deal with a corporate. And when it's a private equity or venture capital firm, it's a deal with a sponsor. And sponsors are usually associated with high-quality deals because they make their living doing deals, improving and selling companies. Some lenders actually only borrow to companies that are backed by sponsors. Then we have short-term and long-term debt. Short-term debt is usually 1 year or lower in duration, while long-term debt is anything longer than 1 year. And you might ask, why is it important to make this distinction? This is because strategies are usually split into short or long-term ones. Just like the structured finance products, you may find pools of loans that are 1 year or less in maturity and pools of loans that are 2 years, 5 years, and so on. This is important because some specific strategies, such as distressed debt or many consumer loans, are short-term, and they tend to be less liquid because a lot of investors don't care for them. Most investors focus on long-term debt because they want predictable, periodic returns for a long time. It's more stable. Then we have what is called the grade of the instruments. They can either be investment grade or not, and that is, whether they are rated at least BBB minus by rating agencies or not. And naturally, the higher the rating, the lower the risk of default. Certain types of debt, such as senior bank debt, are always above investment grade. Intermediate types of financing, such as mezzanine debt, may be or not. They may include different types of instruments. And private debt, such as mezzanine debt, may not even be rated in the first place. Private debt does not need to be rated. It's usually rated in order to make life easier for the other party because they know what's in the package, but it doesn't need to be rated. And high-yield bonds, also known as junk bonds, are generally below investment grade. So the highest grade is almost always bank debt, then mezzanine debt is somewhere in the middle, and high-yield bonds are always at the bottom. That can be secured or not. Secured means that something is used as a collateral to that debt. Technically, it's called having a security interest over the assets. Or, in layman's terms, in case of defaulting on payments, the lender can use those assets for repayment instead by liquidating them. Usually, naturally, senior debt is secured and junior debt is not. This is why junior debt tends to charge higher interest rates, because in case of default, they get nothing. So they charge more interest to compensate for that. It's important to note that the collateral itself may be specific. It may be just the cash flow or just the assets, resulting in cash flow-based lending or asset-based lending. And it's usually only one type of asset or the other, not both. And in case of default, naturally, secured lenders are always paid first. This is why the most senior types of debt are usually secured, because the first lenders to be repaid are usually also the ones that get the assets. Then, the interest rate itself can be fixed or floating. A fixed interest rate means that the rate is set and it doesn't change over the lifetime of the loan. It's a fixed coupon. A floating rate means that the rate may change, and it's usually based on a spread to some benchmark, such as the LIBOR or Euribor, or using their full names, the London Interbank Offered Rate for loans or the Europe Interbank Offered Rate for loans. These are the average rates that banks charge to lend to each other, and then they're used for all other loans with an additional spread. So a bank, for example, may lend at LIBOR plus 400 basis points to LIBOR plus 1,000 basis points. Depending on how risky the loan is and the market, these spreads can go very high. For example, for distressed debt, which is very risky, they can go up to 2,000 basis points. Loans themselves can usually be term loans or revolving loans, also known as revolving credit lines. So term loans mean that a specific quantity of money is borrowed for a specific duration, the maturity, borrowing 150 million over 5 years. After those 5 years, those 150 million are repaid. Done. Revolving credit lines, however, mean that there's usually a maximum limit, and money can be borrowed as many times as needed within that limit, as long as it's repaid back. And this can be repeated as many times as necessary within that period. For example, having a 150 million credit line over 5 years. You can borrow 100 million the first year, then pay it back, then borrow 120 million and pay it back, and you keep on borrowing and paying within that limit. A much simpler example is credit cards. You have a credit limit and you can borrow within that limit. Once you reach the limit, you have to repay what you borrowed in order to borrow again. Usually, for revolving facilities, these can be committed or not. Committed means that the money is automatically lent. The lender already committed to lending that money. For example, the credit card situation. If your credit limit is 20K, then you can borrow multiple times and it's automatically approved. Uncommitted, however, means that the lender may not accept it. You need their validation. For example, a business may have a revolving credit line where for each loan they have to request it and the lender may approve it or not. That's the difference between committed or not. And finally, there are 3 major types of lenders. These are banks, private lenders, and the bond market. Banks usually provide the most senior type of debt with the least cost, but it's usually with very strict covenants in financial demands, and it's usually secure debt. In short, it's cheap in terms of money, but it's expensive in terms of demands, and the borrower has to be very creditworthy. So many businesses can't even go to banks. Private lenders are somewhere in the middle. They provide that is less senior to banks, so they get repaid after banks, and it's precisely why it's also more costly. They charge higher interest rates. Their debt can be senior or not, and it can be secured or not. The investment vehicles can include business development companies or private credit funds. And we'll take a look at this in this module. Their types of debt can include mezzanine, structured products, or other types of flexible instruments. Out of curiosity, banks, with more and more regulations, are lending less and less, so private lenders are increasing their market share more and more. And a third type of provider is the bond market. Borrowing bonds is very simple. As a company, you create a bond that is sold to someone else. For example, if the US government sells you a treasury bond, if you buy it, you received fixed income payments over the duration of that bond. You paid for the bond, and now you get periodic payments. This is the exact same thing, but with a company. As a borrower, I create bonds, and then I issue them to people that lend me money. And they lend me money by buying those bonds. Because they have those bonds, I have to pay them periodically. This is why the borrower, in this case, is known as the issuer of the bonds. You can think of it as the following. Instead of an investor buying treasury bonds and being paid by governments, they buy borrower bonds. They are paid by the borrower periodically. They become lenders by holding the bonds of somebody else. And please note that bonds come in all shapes and sizes. They can be low risk, high risk, and the same company can issue different types of bonds with different types of quality for different investors. This market usually includes many types of bonds, and usually public. A big portion of them are high-yield bonds, also known as junk bonds. These are bonds that have a very high risk of default, but to make up for that, they have very high interest rates, or very high yield for the lender. They usually also have other investor-friendly characteristics, such as something called an equity warrant that allows a debt holder to convert their debt to equity if the company is very successful. And they are frequently part of leveraged buyout financing. In many situations, all these types are used. For example, when financing a deal for a leveraged buyout, for example, there are usually 3 different tranches: a tranche of senior bank debt, a tranche of high-yield bonds, and then some kind of mezzanine debt or other private debt in the middle. This provides diversification. Because if you think about it, a part of that debt is very cheap but very demanding, and another part is more expensive but has lesser demands. What are some examples? The first are the WIBOR or Euribor. These are international benchmarks of the interest rates among banks when they lend to each other, and they are used as the basis for floating rates for every other loan, or at least the loans that have floating interest rates. They usually have spreads that represent the risk. They're usually between 300 or 400 basis points to 1,000. In the case of very risky investments, such as distressed debt, they can be higher, such as 2,000, as we've seen. Then, debt can be rated or not. So public instruments are always rated, because they need to in order to be publicly tradable. So it's easy to determine what is investment grade or not. But private instruments may be rated or not. They can be rated in order for the other side to understand what they're buying more easily, but they don't need to be rated. And finally, the term deal financing is the name given to, in private equity, the structuring of the debt in order to buy a company, usually for leveraged buyouts. In other words, the private equity firm wants to buy a company that costs 10 billion, but they don't have that money, so they borrow that money. But they have to borrow it using very specific instruments that make sense, because they usually put that debt on the company and it has to repay it over time as it grows. The process of selecting those specific debt instruments is known as the deal financing, and it usually includes bank debt, mezzanine, and high-yield bonds, a little bit of each. What are our key takeaways? The first is that debt instruments can be public or not. Public instruments are less costly and more liquid, but they are more regulated and demand more transparency. The two major uses of debt are to finance operations of a company or to finance transactions, either helping a company run itself or helping a company buy another one. Then, interest rates can be fixed or floating. Fixed rates don't change over the lifetime of a loan, but floating rates change based on a spread to a benchmark such as the London Interbank Offered Rate. Loans can be term loans or revolving. In a term loan, you borrow a specific quantity over a specific date, but in a revolving credit line, you can borrow multiple times as long as you pay it back. And there are usually three types of lenders. In general order of seniority and inverse risk of default, we have banks, private lenders, and junk bonds. Private lenders are usually somewhere between both extremes. So as we see, these different characteristics of debt have different consequences in the lending process. They may shift the power dynamic from the lender to the borrower or vice versa, or they can just make sure that this debt represents a different quality instrument.